This is the syndication cram school that we do every third Saturday. We are jumping into the seventh section of the syndication. This section today is about other investment options that are syndicated. I think we started off with multifamily apartments, which is primarily the thing that we operate. We've probably done well over 60 something deals in multifamily apartments. We started with a lot of smaller 50 unit type Class C projects and then jumped up to a lot of Class B assets in 2019, 2020. But as you've seen us move off to more developments, that's another type of asset class that's out there, still in the realm of multifamily apartments and still the workforce housing investment thesis. But what are other things out there? I think people talk a lot about self-storage, mobile home parks. We're going to get into that today. A few miscellaneous things, taxes. So if you're a passive real estate investor, what I would recommend is check out our tax section at thewealthelevator.com/tax. But typically when you're investing in a private investment fund, syndication, private placement, the income that you get, whether from an exit or obviously the cash flow from there, is likely to be categorized as passive income. The cool thing about that is passive income should be able to use passive activity losses that you can get from these types of investments in real estate from the depreciation and deductions. But also we've got the tax pile fund where you can invest in equipment, gets you Section 179 losses. The cool thing about that one is you don't have to recapture those losses. In real estate investments, you get the losses, but you have to recapture it at the end. So it's deferring it. But 179 deductions, the equipment is usually salvaged or sold for pennies on the dollar. And the nice thing about that is you don't have to recapture those losses because it's sent away. But we're not going to get too much into detail on the taxes. I do suggest that you learn it because majority of CPAs don't understand this stuff. I usually see 95% of our clients change their CPA from their current one, unless it's like their brother-in-law and they're stuck with them. If you guys need a referral, let us know. Just shoot at the team an email. There's other kind of income, such as ordinary income, which a lot of you guys get from your W-2 day jobs or your 1099s, depending how you're paid. But that's all the color of that money is ordinary. And you can't use the losses, even the 179 losses, to offset your ordinary income unless you have real estate professional status, which a lot of people in our group are pulling off. I would say talk to a sophisticated CPA, the one that is open-minded about this type of stuff, and see how you can get that working. Because once you unlock that sort of cheat code, now you're able to use the passive losses to offset your entire income. And that's where you're able to drive your adjusted gross income to whatever you want, assuming you have enough passive losses. But yeah, you'll get these K1 forms from these syndicated deals if you're an equity investor. If it's a debt deal, and we talked about that, Section 2, where there's equity or debt deals typically you're going to get a 1099. But what I would also say, I'm not giving any tax or legal advice, again, for that, work with a professional. But I think really there needs to be some onus on you, the investor, to guide your CPA the right way. I see a lot of CPAs, like I said, like it's coming up as a K1 and they categorize it as ordinary income. Like to me, that's craziness, but it happens. A lot of you guys put too much respect in that position, but I'm like, man, like those CPAs, that's why they're working that day job, right? Because they haven't figured out how to do this themselves. So why would you want to take financial advice from somebody who's still stuck in the day job? But as we talked earlier, a lot of these deals where you get losses or bonus depreciation, passive activity losses, typical deals out there, maybe they last 3 to 7 years, depending on the business plan. Like a development could be quicker. If a value add deal goes through a difficult time or a recession, like how we've seen in 22, where you're just waiting for the market to come back, cap rates to compress. Again, you could be in there for quite some time, 5 to 7 years, maybe. And that's just the nature of investing. but you're going to have to manage the amount of passive activity losses, which again, if you haven't yet, everybody here should know what's on their 8582 form if you've already been investing in real estate or other projects. If you're new to this world, welcome, but that you're going to get very interested in what's on that tax form. And kind of the point of this is you need to be going into multiple deals, not only for diversification's sake, but for taxes too. If people have watched the old school Willy Wonka, Charlie was broke, right? So he didn't have money to go buy the chocolate to enter the contest for the golden tickets. And he said he bought 2 chocolate bars, and his person's, what? 2 chocolate bars? You gotta be kidding me. Just two? And that's how it is with syndication deals. People get started, they might do a few of these things, but that's just not diversification. What people need to be thinking about is going into a deal every quarter, or at least two a year for 5 years. And if you're going to deal every quarter, that's 4 a year. And if the average pipeline on a deal is 5 years, 5 times 4 is 20 deals at 100 grand. 20 times 5, that's $1 million right there. Or actually, that's $2 million. And it might be sticker shock to you, but that's diversification. And that's what it's like to have a substantial amount of your net worth into alternative assets. If you're over $3 to $4 million, you may not need to go over 50, 60% of your net worth into this type of stuff. But this is definitely what got me over that hump and got me to where I'm at today. The question that comes up a lot of times is like, can you 1031 other real estate or other assets into these types of projects? The answer is no. If you're coming in, you're selling other business holdings within the same structure, like an LLC, then yeah, it's possible to do what's called a TIC. We call a TIC a tenant in common. Tenant commons are very costly. They're real pain. You basically have to go in conjunction on the side as an ownership structure with all the other 50, 100 plus investors in the syndication. And as you can imagine, it's very costly and annoying. So unless you're willing to bring in $1 million to $3 million, most operators who have any type of business savvy or not desperate for cash is going to say, sorry, man, we're not going to accept you as the tenant in common to tick. So that's, as you guys have seen in some of my previous videos, that can be a sucker test. Maybe I'll put the video in here, but it's on the YouTube channel. But basically what that sucker test is, you asked a operator, hey, you willing to take me in at $25,000? Any decent operator over $1 billion under management is going to tell you to go take a hike. They know you're going to be really annoying to work with if you're not at least willing to put in $50,000, $100,000. Very similarly, anybody who has done it before and has any decent investor list and not desperate for cash is going to tell anybody who's doing a 1031 exchange type of situation to go take a hike unless you're bringing in more than $1 million. So that can be a test right there. I think that's the hard thing. Like, people go through this eCourse, you're probably realizing that, all right, the section 2 number section was very insightful, where you're going through the numbers and you're figuring out which deals are underwritten the right way with reasonable assumptions. And you're at least working with people not with a @Gmail account and have a bit of a track record and not a fake it till you make it person. But even at that, it's just really hard in this world to figure out who is legit in this business. And that's where I made a lot of mistakes when I first started investing. My first 15 deals that I invested, my failure rate, if you call it, was about 1 out of 5 projects. And that's why I tell people, if you're going to invest more than $250,000, 5 deals at 50 grand, it just makes sense to join the family office Ohana group, that we build real relationships with other passive investors out there within that group. If you're not that good at making connections or building relationships, that's why we made that group, because it operates like a brotherhood and sisterhood where we help each other out. If you're out there on your own, the world's difficult, and you're probably just working with those operators that are really good at marketing and not necessarily any good. And that was the same landmines I stepped on initially when I first started as a passive investor, until I started to develop my passive investor network around me. I had a question here. What qualifies as a failure in your eyes? One case, I had a deal where general partner was stealing money and I had to take over the deal and remove them. And nobody reads the PPM. I'm saying that jokingly. Some people may think that's absurd, but I think the majority of people say, yeah, I don't know what the heck is in that thing. And neither did I when I first started. Until you go through things, because that's how we learn as humans, right? You don't learn unless pain and you go through trials. And that was where I learned about that little paragraph in the buried in the PPM where if the operator, every PPM is different, of course, but where one of the general partners, if they do any type of misconduct or they go insolvent or go into bankruptcy, and there usually is some type of provision for the passive investors or other general partners to do a proxy vote to get them out. So that's what we did. And then I took over the deal. Luckily, we still made money on that deal and was able to get out. But yeah, when people do that type of stuff, it's first not only like very difficult to prove it legally, and oftentimes it's like throwing good money at bad money that it's just not worth to go chase the guy, which also introduce a secondary tip. You invest what you can lose, right, in a one-off deal, and that's why you diversify. I know nobody likes to lose 50, 100 grand, but if it was like half a million, $1 million and your net worth was $3 million, that's a bigger pill to swallow. And that's why we always say you never want to put more than maybe 5 to 10% of your net worth into any one particular project. Diversified funds are a little bit different because it's diversified, but yeah, single asset LLCs, that's a general rule of thumb that I personally have, which is why I don't know how many K1s I get, like 80 or 100 K1s. And I would consider that a failure, but maybe I consider that a success where you go through all that type of stuff and you still made money. I think we made 8% a year over like 2.5 years or something like that. Another couple of times, it's just the deal was just a flop and we didn't make any money. It was just a neutral exit. But it happens. That's the world of private placements and syndications. That was a long-winded answer to people realize they're like, all right, I get the numbers, I get the stuff. And it's like, all right, I see the forest from the trees. It's all about working with people you like and trust. I'm like, yeah, bro, that's what it is. Unless you're going to invest with a institutional operator where you don't have the good fees and splits and you're going to maybe double your money in 10 years plus, rolling the dice with unsophisticated operators who are just good marketers out there because people fudge the numbers all the time in terms of their track record out there. So a lot of this stuff is review. I wanted to really get into them scrolling here. If you guys have any questions, type it into the Q&A box there. All right. So we talked a lot about apartments, industrial, office, retail, hotel are some of the major food groups out there in terms of the real estate world. Outside of the real estate world, there's all these other different investments. I actually just went to a venture capital conference all day yesterday, and that is tech startups and different types of physical product startups. Venture capital world, you're investing in things that don't have any current income. There's no profit and loss statement. And that's, I think, the appeal why I think a lot of people, and myself included, when you're investing in something, it's nice to know what the trailing 2-year financials are on an asset, see what the income is, see what the expenses are. And on such a time tested asset like real estate, whether it's an office building, retail storefront, shopping mall, industrial storage, when you get into venture capital, you don't have that type of stuff. Depending on which series or seed capital round, it's just an idea at that time. Returns can be very explosive. But at the same time, coupled with the majority of times, maybe call it 90, 99% of the time, you lose all your money. And that's just how those types of investors invest. It's very asymmetric is the term. And I would get very used to using that word that's new to you. Asymmetric is a term where it could blow up and be a great investment. I got a buddy that invests in Broadway plays. I'm just throwing that out there to expand your mind. But Hamilton, they invested in, and I think it must have been like a 30, 100 or to 100x multiplier, not a 2 multiplier that most real estate deals will be shooting for. That said, I think real estate deals, they typically have a much higher success rate, but that success multiplier isn't that high. I think what attracts the people within our community is value investors. And I think that's why people like to build relationships in here because it gets down to your investment values. At the end of the day, when I think, why does this stuff attract me? I like things that provide utility to the majority of people out there. Maybe that speaks to like my value of being of service to the average middle class, lower middle class American out there. You may not believe the same thing and that's just your thing. And I think you also need to think what do you really believe in as an investor that's really here for the long term. Many of those venture capital types of investment, the whole idea is you're just trying to get it, build the product and sell it to an institutional buyer like Microsoft or whatever to have an exit. It's not a long-term play and there's a very finite window where this product will be valuable. And I think somewhere between that venture capital world and this world that we're talking about, there's SaaS businesses and e-commerce business. So these businesses are generating money. There's P&Ls there. I was actually in a mastermind that really specialized in this stuff because essentially I really run like the Wealth Elevator, if you haven't noticed, is a content website. So that's the trifecta that's called content websites, e-commerce, and SaaS businesses, which are subscription-based online software type of businesses. So those types of business are in process. It's not like a pipe dream. The returns are better than real estate typically if you can value add them, but there's none of that concept of the physical asset there. And another example would be like crypto. We'll separate the altcoins, which are the very explosive types of speculative projects versus Bitcoin, Ethereum, which are more like the blue chip type of cryptos out there. I think the reason why, just to go more into my whole viewpoint, like crypto, like what utility does it provide? Like gold, what does this gold coin provide? Sure, it's a commodity. I'll give them that. But what does it provide? Whereas like real estate, apartment complex, at the end of the day, it provides real utility to majority of Americans out there. So I hopefully that little talk just made you think about what resonates with you as an investor and your value system. Because if you're investing in the S&P 500 or your 401k, likely the majority of your holdings is in the big five, right? Go look it up. What is the S&P 500 weighted in? It's the FANGs, right? Your Facebook, your Apples, your Google, which is Alphabet. It's primarily that stuff, which is really not diversified and which is why it goes up and down like a roller coaster. And that's how pretty much how most of these mutual funds are. It's pretty much just predominantly Apple for the most part. And someone asked, what is the Sharpe ratio? If you were a college professor who is really steeped in theory, there's this thing called the Sharpe ratio where you're able to calculate the amount of risk versus reward. And this is just one arbitrary chart here. I wouldn't really read into it. And things change all the time. And when you're seeing these charts, remember, it's always backwards looking. It's a trailing indicator. So don't be a myopic investor. Only, "Oh, I'm going to look up the best Sharpe ratio. I'm going to invest in that, right? Don't do that. Then that's what separates good investors from bad ones that should just invest in the stock market. Mutual funds is you need to take in the entire big picture and then talk to other sophisticated investors and really mesh your ideas with other people and share ideas there. But it's impossible to get this data, but it's just an idea is the whole thing. Technically, you want to be going for a deal that has a decent Sharpe ratio, but not a sucker deal is what I call it. A sucker deal is a deal that has a credible amount of upside. So it looks good, right? It's, wow, this thing could triple my money in 2 years, but it's incredibly risky. And the risk is the thing that most investors have a really bad time of evaluating. So an example of this is a Bitcoin mining machine deal, which typically go belly up. And I've probably seen like 3 of these things. 2 of them go belly up over the last 5 years. Again, not saying that it's a bad thing. I personally am not like aligned with my investment value system to invest in that type of stuff. Unless I know it, if I'm going to use my flyer portion of my net worth. And this is where investors need to recognize that a certain amount of their net worth, call it 1%, call it 5%. Heck, if you're lower net worth, it might be 30% of your net worth. I don't know. There's no rules to this, but you have a certain amount of your portfolio that you earmark as asymmetric. And I'm not telling you what your amount is because then you'll get upset at me and then you'll blame me for your problems down the road. But you need to figure out what this number is for yourself. Myself, maybe 5% of my net worth, I might throw to a venture capital deal where I could 50x, 100x my money. And if I don't make it back, then I'm not worried about it one bit because, hey, that was a flyer in my idea. Depending if you were able to figure out what the Sharpe ratio was, the Sharpe ratio might actually be really good, might be really high, but it still might be a bad deal for you to go into, if that makes sense. Investing in hotels. So hotels are traditionally a little bit more spicier asset class of all the real estate asset classes. Why? Because just think about it, right? One of my partners owns one of the hotels near Times Square. When I stayed there, he gave me the family and friends rate, but it was like $250, $200. But when it's New Year's Eve and it's just packed out there, the rate can go up to 500, just crazy prices, like double, triple than what it was. And this is a term that we call dynamic pricing. And in a way, we do the same thing with our apartment complexes. Like when we take over a project, we are going to be a little bit more ginger on ratcheting up the rents because we want to just see how it runs and we want to stabilize occupancy in the low 90% range if we can. Then we go and re-renovate units and then we push rents after a while after we have a good amount of occupancy in it. So it's this mix between sometimes you're optimizing for occupancy, sometimes you're pushing the rents and your occupancy will probably drop at that point. But in the long run, that's how you flex back and forth. And sometimes it can even be week to week. You know, what is the property manager dealing with that week? They're seeing the amount of incoming leads and it's very dynamic. And this is a lot of the things that kind of go on behind the scenes and passive investors don't really have any insight into. If you're a passive investor investing in 20, 30 deals, you shouldn't really be worried about it because you're a passive investor and you're properly diversified. But this happens like on a daily with hotels. And as I mentioned, like the average daily rate can jump up to 3x. On the one hand, it can be very lucrative and it can create a lot of extra margins. Because sometimes, most times with apartments, you get to a point where you can't push the rents. I'll use an example like Oklahoma City is not a market I'm a huge fan of. You just can't push certain C-class assets past 700. And there's like a ceiling. Whereas this is what the nice thing about doing nicer apartments, people are a little bit more price insensitive to that type of stuff. So you can keep pushing and you're like, wow, when is this going to stop, right? Hotels are on that same spectrum. So there's a video here about hotel investing 101. And of course, like hotels has the same concept of you have A-class hotels, B-class hotels. In hotel industry, we measure it more on like the star rating. So like a Four Seasons, like a 5 or 6 star. We've bought a hotel, actually a couple of them, but like the one that we currently operate is the Holiday Inn in JFK out there in Queens. That is considered a 2-star hotel, the free breakfast. It's a very competitive market, but the reason why it's competitive is like there's a lot of regular people travel. I'm talking about who make, under 100 grand a year, that type of people. The majority of Americans, they'll stay in 2-star hotels. And this is where I think maybe some of us who travel a little bougie need to separate how they do things. Or if you do Airbnbs, you may not be the average customer going into these things. And that's where I guess I'm bringing up a point there. Like the nice thing about investing in apartments is most passive investors understand it. Like most people have owned rental properties, so you understand the dynamic of the landlord-tenant relationship and dynamics and how the economy impacts things. The counterpoint of that is, well, as a passive investor, it doesn't matter because you're a passive investor. You have an asset manager, the operator who has skin in the game. And that's why there's a line splits. And that's what's the difference between just handing your money off to Wall Street where they don't really have skin in the game to optimize the asset. Another thing is like shopping centers. Now, in the shopping center world, you have shopping malls, like the big ones. Normally, I beat up on shopping malls because the whole thing of like people aren't going to the malls anymore as they did in the retro 90s. And see a lot of them being abandoned. The shopping center, which is the one where you have the Safeway or Whole Foods at as your anchor tenant, and then a lot of the food takeout place, the barber, the dentist, a lot of those types of places, even in a post-pandemic world, are still going to be used very widely by most people out there. And this is where you start to apply which of these asset classes are somewhat recession resistant or the future is uncertain. And you're trying to think, what is it out there that if this world does change, is still going to be around in some way? And yeah, I definitely believe shopping centers are one of those things. Within shopping centers, you can also have a lot of these what's called triple net type of deals. So triple net essentially means that a lot of the maintenance repairs gets passed off to the current tenants in there, which makes the investment have a lot less risks and uncertainties with that. But also the returns are lower with that type of stuff too. And you'll see triple nets in the shopping centers, industrial assets. You won't really see that in apartments and more residential things like that. And the other things to keep in mind is your tenant base. When you have hotels or apartments, typically, at least when you're doing class B and C, your tenant is a very financially unstable individual. Sure, there's a lot of individuals that kind of make up for it. A lot of these guys, like if their car breaks down, they're going to be having a hard time paying rent. And this is why a lot of our Class C assets that we started out with had 80% collections, where 1 out of 5 people were sort of deadbeats and just didn't pay. And we had to chase them down. And that's just how it is. When I first started to get into this business in 2013, I was like, it was a culture shock for me. It's like, why does my tenant not pay me every single month and they're willing to spend like multiple $50 late fees? And then I didn't know you could get a money order from Walmart. Like, why are they doing that and paying Walmart $2 or $5 for that money order and paying their late fee on top of that, which is like 10% of their rent? And they're doing this like pretty much several times a year. Made no sense to me because I'm just like sheltered Lane here who happened to grow up in a well-off in comparison family. But that's just how the majority of Americans live. Now, when you get into shopping centers, industrial asset classes, your tenant basis switches to commercial tenants, and where the due diligence falls more on the individual tenant, which could be a company that generates $30 million of revenue. So very financially stable companies and therefore a very financially stable tenant base. But with a shopping center, you may only have 7 or 15 tenants. With a industrial property, you're going to have maybe even one tenant, right? So the concentration is a lot smaller, but the individually, I think this is why a lot of sophisticated investors, institutional investors drift off away to these types of asset classes because they can sophisticatedly underwrite the tenant, and that is ultimately their backstop. Hotels, for example, it's the same tenant base as the apartments, some good, some bad. But as I mentioned, need is different. This is not the discretionary part of people's budgets, going on vacations or traveling for the baseball team to the nearby, needing a hotel, needing to stay in the Holiday Inn. In recessions, this stuff gets cut out. And this is my big angst for a lot of people out there. They used to go after single family home rentals, and then things got more and more expensive in the run up from like in 2018 and beyond, where a lot of people were going to short term rentals because of the Airbnb thing. But I didn't feel comfortable as an investor, and it didn't align with my values because that is a discretionary part of people's spendings. And in a recession, people stop going on vacation, right? Also in pandemics, people don't stay in hotels. So I still think that there's going to be a big fallout in short-term rentals because a lot of amateur investors got into that world and kind of pump that bubble up. And when you combine that with any type of weakness in the economy, people are going to stop going on vacation, to stop staying in those Airbnbs. And that might be a good opportunity for a lot of you guys to not pick up the short-term rental, but pick up that property to live in your nearby area, right? Step up to take advantage of people's misfortunes there in a way. But in these commercial assets, the value add, where's the value add, right? I think that's a smart question to ask for every investor. I get it. Like, we're not in this business to not necessarily buy, hope, and pray. That's what unsophisticated investors do. That's what I did when I first started. I would just buy a turnkey rental and just hold on to it. And yeah, typically real estate goes up and you want to see high inflation as an investor because that inflates the prices of all these assets. I wasn't doing any rehab. I wasn't doing any type of that type of stuff. And that's where syndications and private placements really unlock that for a passive investor. You can partake in that value add strategy without rolling up your sleeves and taking on a lot of risk, dealing with contractors and all that nonsense by yourself. In these other asset classes we're talking about, like industrial properties and commercial storefronts and shopping centers, the value add isn't necessarily in fixing up the asset because it's like I said, the interior improvements are typically burdened by the tenant. And, in these assets, after it gets old, you just break them down and build a new one. But the value add is in the leasing up of the assets. So imagine if you have 12 vacant spots in your shopping center and the valuation is again based on net operating income divided by the prevailing cap rate, as we mentioned earlier in a previous section in the eCourse. If you're able to increase that rent by maybe you swap out like Tom's Deli for Starbucks, or you get Tom's Deli to sign a longer lease. Each of these leases, there's a bit of a calculation that I'm not privy to. This is where real estate brokers really have a big hand in evaluating these, looking at each individual lease and how that combines the total value of the entire property. Where some people who are really good at negotiating or managing their property manager to negotiate these leases on their behalf can do a lot of virtual value add, nothing physical, right? But the leases are improved. You can make the property increase in value, and thus that's a value add strategy. Something I think you could all us are pretty smart here. You guys understand this very well. But again, raise your hand if you were a commercial property landlord, property manager. Probably nobody here because they don't get paid too much too is another thing. And most of you guys are already accredited investors here. So that's a way of value adding the asset. You buy a shopping center with maybe some vacancies, maybe some expiring leases. And that's part of the whole deal as an investor, right? You're going into a deal with always a little hair on it, and you're looking for things like that. Like even apartments, right? Like you're looking for a property that has a beat up pool sign. It's just got a crappy gym. Things just looks beat up. There are obvious signs of physical improvements that can be had. A lot of times, investor, you won't be able to see, or even when we take over, unless you do the walkthrough and you get the team in there, you can't see the improvements that can be made within the leasing, the management, increasing some extra income or decreasing expenses here, improving the business. And that's essentially we take over a business, whether it's apartment or a shopping center, and you're trying to improve the net operating income or the bottom line. And that's the name of the game. Another thing that people talk a lot about is self-storage. I'll briefly go over that. I'm not a huge fan of self-storage because the reason why I like multifamily is there's different classes, A, B, and C class. And if you're like thinking the way I do and you're trying to cater towards the middle class, lower middle class, which is categorized as workforce housing, if a class A luxury apartment, which is everything that gets built new is categorized as class A, and it's going to be more expensive price per square foot to live in. And we actually try to invest in these types of situations where a new apartment is coming up because that is verifying that an institutional investor is saying, yeah, this is a good area. It's going to get absorbed. The units are going to get absorbed and people are going to move in here. but it also pushes up the pricing in the area and also improves the area. So there's not this cannibalizing of direct effect there. When you have a class A apartment move in next door, it's a symbiotic, it helps improve the overall community and helps us attract better tenants in the area. And our strategy is to go for those value tenants, the majority of tenants out there who don't need to have a fancy bar or Peloton bikes in their apartment and paying $2,000 a month rent, but the sort of value conscious one that's paying 1,200 next door or in the same submarket. So these apartments and real estate, whatever asset class is continuously getting redeveloped and new stuff is coming in to replace the old stock that is decaying and becoming dilapidated. This is seen very well in like Las Vegas. Like you have the really nice hotels. I guess that would be like the Aria now. The Wynn is still nice, but it's old. But like Circus is like an example of a Class C asset. And at some point, they're gonna just take that thing out of its misery and just bulldoze the thing and build a brand new Class A casino there and hotel. So these things, they go through a life cycle and no different than an apartment. The reason getting back to self-storage, when new self-storage facilities are built, it typically competes directly with the self-storage that maybe you have gone into. Now, you might have been investing in a Class B self-storage facility, but typically the business plan on all these things is to get it air conditioned, get the security system and get the lighting and up level it to a more of a Class A level so that you want the spouse to be able to go there at nighttime and feel safe. This is where, unfortunately, your business, when you take over a self-storage facility, is always going to be competing with new stuff coming online. And you combine that with the fact that new self-storage facilities are very easy to build, right? Just think of it. They're just storage lockers. It's so much more easier to build than a hotel or a apartment. And that's what I just don't like. I don't like how there's not really a moat around it like how there is with apartments. Yeah, so the reason why we do multifamily in this workforce housing sector, which you could call lower class A to B to C, is this whole idea of when there is a recession, and I'm sure there will be a recession. Technically, I think we hit rock bottom here in 2023, and which is why it's a great time to invest off of the bottom right now. But in a recession, people are a little bit more budget conscious, and you have this effect of the A's moving to the B's, moving to the C's, is a theory. That said, you never know what's going to happen. There's always risk in investing. And when we went through the pandemic, nobody knew how that would impact things. In reality, what ended up happening is the Class C people were hit the hardest. And we saw our lower end tenants struggle the most, where my class tenants and B plus tenants were totally fine just working from home. I had one apartment where we had a lot of the tenant base was Indian, very budget conscious ethnic group. And they had a lot of IT jobs. I don't want to be stereotyping, but they were. And those guys are amazing tenants. And so during the pandemic, they just stayed put and worked from home. And some of them ordered Uber Eats. But shortly there, once things opened up, 2021, with the conjunction of like historical low interest rates, a lot of these guys were able to save up and to go buy houses, and they left us. So we had a dip in occupancy because of that. So who would have known that would happen, right? Now, obviously, in hindsight, it makes total sense, right? But when you're going through it, you're not going to have these trailing indicators, and you never know what's going to happen. And again, that's why you diversify, and that's why you have to understand, think of all the things that could happen. Some people, they don't do anything. I think that's the big mistake if you're one of those individuals. They always say it will happen, but in a different way. Same thing basically is my example there. Any other questions on any other real estate asset classes? Trying to think of, I've actually done like boat storage. So that's under the realm of storage. I've done a deal like that as a passive investor, actually, just because I was interested in it. And I'm always like guinea pigging things for folks within our group. And boat storage caters towards a little bit more affluent type of tenant base. So they're a little bit less, more recession proof. And this is where we own hotels too. So the funny thing with class B or 2-star, 3-star hotels like Holiday Inns in recessions, those hotels actually do worse because the lower middle class Americans, they just don't travel during those times. But the high end hotels like our Four Seasons, those things go gangbusters as we saw through the pandemic. That's so it's a little bit counterintuitive. In recessions, your price insensitive rich people, they're just going to do what they're going to do. So a case can be made for investing in things like that. And I guess you could probably put boat storage, even if it's in like a a scene from like Crime Scene Investigation or one of those crime movies, one of those kind of beat up old looking boat storage places. I think, not saying that that's a good thing to invest in, or I don't think most of you guys will ever invest in a type of deal like that. But I'm just trying to give you a little insight on how to look at these types of investing. Like, who is the end user? How are they impacted during the recessions? Are they price insensitive? Are they, and both storage is kind of one of those things that I believe. The other in that deal, we got really lucky because we sold that thing right before. It was like in Port St. Lucie, and I actually didn't even know where it was, and it was never there. And that's how passive investors, you just spread it around a little bit. But I think, yeah, we doubled. I think I doubled my money on that one. But it came right before they had a couple of big hurricanes, so it's pretty lucky on that one. We had a sort of unrelated question here: opportunity zones. So this is technically not like an asset class, but it's a way of kind of investing with a tax in mind. I stay away from deals like that because they typically go out to like Wall Street type of investors. At the end of the day, like I like to invest in like strong areas, and opportunity zones are typically code name for crap areas, which is why it's an opportunity zone and the government wants to incentivize people to go there. So for me as an investor, it just doesn't align well for myself personally. Not saying that's for you, but if you're investing in real estate, or especially with the tax pal fund, all those Section 179 deductions that you don't have to recapture, that's just a much better way of going down this road of mitigating taxes. I'm sure land conservation easements, a lot of our folks would do, have gone by the wayside with the omnibus bill, cranking that thing down from 5x multiplier to 2.5x. Oil and gas is another way people will mitigate taxes, but man, is that asset class riddled with shady operators in that world, which is why I stay away from that. But I would say jump on the office hours and let's talk to your specific situation because most of you guys don't really have a tax issue. If you're not making more than $385,000 a year, you're not in the higher tax brackets. So probably just better to sell off your asset and just pay the taxes on it. And a lot of times you guys are selling off asset and barely having opportunity zones make sense if you really are like selling something for 500,000, multi-million dollar capital gain. Then you do those types of things where you let the tax tail wag the dog. That saying is doing stupid things to save taxes, which means investing in a crap area that might be good in 10 years to just save some taxes today, but then the investment doesn't do well. So to me, because we are aware of and do these other tax strategies that do often the same thing and is a proxy to mitigating taxes, I don't see opportunity zones. I don't think it really makes sense for most people. We've done it, but it's always, oh, this place is an opportunity zone area. I'm in a deal like that where it's sometimes you can get lucky where you're in that gentrifying industrial area where it's being cool again. Again, I don't want to offend anybody here, but typically in some investors who are a little bit more aggressive, they'll look for the kind of the artist district or the LGBTQ type of area. But like these types of areas are the artists will go in here. We're broke, right? That's the same broke artists will go in here and live. And they typically make a pretty cool, vibrant community, similar to like, I think people live in Seattle. Capitol Hill was like this a decade or two ago. We had one of these things and in one of our deals where there's a Starbucks right there. and you would have never known that you were in an opportunity zone. So there are exceptions to the rule here, but I don't think that it makes sense, especially when there's other tax mitigation strategies. Yeah, so I was going to leave real estate here and we'll get there. But before we leave the world of real estate, somebody asked a question on Section 8 syndication. So Section 8 is the low income type of government coupon, basically free rent, or you don't have to worry about your tenants being junk and not paying. I'll also lump into here Lura, Lurk, Licta. There's all these different acronyms, but basically, like the developers, when they build the property, they'll get some type of tax credits, and the trade off, the quid pro quo with the city or municipality will be like, we'll rent out 20% of the units at 80% of market value so that it's a benefit to the community. And then the city signs off on, yeah, you can go ahead and build your apartment. I think I have two of these types of apartments. They're Class A apartments because they're newer. And there's 20% of the units at like 80% level and it's a little annoying. I'm actually looking at a deal right now. If some of you investors who are new are really serious about looking at some of these deals, might share like a little screen or a video of me going through this particular deal where it is exactly that. The developer who built it in the last decade is selling off the property. And the nice thing is that the low income restrictions or that the low rent restrictions are burning off. And these deals these things they put together are all different. Most times there's sucker deals for new syndicators to buy where it's not necessarily burning off right away. You got to wait 3 years. The good ones are the ones that it's already burnt off and you're already seeing the traction and the rents are going from $1,000 to $1,400 and you're able to verify this. This is what we do. We go and verify that how many units got absorbed at the higher rate. Because most times like people, like you're going to shake a stigma if your property is the low income Section 8 property. We all know that's where you get the drugs from. And it's going to take a decade for it to burn off. And this is unrelated, but it also gives you an idea. Like we have some properties that do have some Section 8 on there, but we try not to stay in this world of Section 8 because whenever you have more than 20% of Section 8 people in a property, you're the one with the shoes hanging from the power lines. That's the code signal to get your drugs from here. If you haven't noticed that one. But it's just what we found is we're just not set up for that. Like we are, maybe call us like fair weathered operators, but over the years, we realized is we don't want to take over a property that's not 85% occupied or better in bad areas and not a huge lift. Now, some operators out there, they love that type of stuff and they can make a lot of money doing this where they take over just a beat up property in foreclosure, Class C tenants, Class D tenants. That's just not our prospectus. And it's just why I think maybe you're seeing, this is why as a byproduct from it, like you're seeing us move more into developments, right? We would rather take on the risks and uncertainties of construction than the risk uncertainties of people. Because then you've got murders on the properties and it happens all the time. When you got 10,000 units, people are going to suicides, murders, lawsuits all the time. And this is why it's nice to be a passive investor. Most times you guys never hear about it. Most times I don't even hear about it. Like the lawyer just takes care of it for me as like the general partner. I try not to worry about it at least. But that's the kind of the dark side of the business. And that's why it's nice to be a passive investor, that your downside is limited to what you initially put into the investment. And you're not the one who's co-signing on the debt. You're not the one who has to go to court to fight a fictitious legal case. If you're hearing it from my voice, it's very frustrating, right? As a passive investor, that's why it's nice to be a passive investor. But yeah, I just don't choose to invest that way as Section 8. And at the end of the day, maybe part of it is you got to feel good of what kind of business you're in. I always like to think of my investors first. We're getting good returns. We're saving money on taxes. That's it. Obviously, you guys see I get really jazzed over that type of stuff. Secondly, I like the whole idea of we're improving a community. I really like the idea that we're kicking out these deadbeats. Like the people we come into a property, everybody, I've sat in the property management and just talk story with them and even on a small property, like a 100-unit property, that property manager knows who's having domestic problems. They know who are the 3 or 4 drug dealers in the complex. They know, and we get them out. We phase them out because typically these lowlifes that are soon to be old tenants of ours, they don't belong there. That we're improving the product, we're improving the community, we're improving the interior units, and these guys can't afford the higher rent. And what I truly believe is like the majority of the tenants in there are good people, and I think they really like it when something forces these lowlifes, these deadbeats, out of there and improves the community for them. When we improve their unit and they have to pay a little bit more, but they know that we've shed 5 shady characters out of 100, I really resonate with that. And I think that's why I invest in these types of non-Section 8 investments. It would be a super lucrative way of investing. And maybe I mean, you diversify, right? Like still within the world of real estate, still within the world of multifamily apartments. But yeah, I wouldn't say that as a passive investor, I wouldn't invest in something like that. Something similar along those lines. We tend to invest in red states and states where the rent to value ratios where we can cash flow the investment. But there are some operators out there, they like especially like in high price areas like California. I've seen operators out there who specialize in getting people off of their low income coupon and getting new tenants in there and oftentimes maybe even doubling the rent overnight. Now, from a ethical standpoint, some people say that's messed up. On the other hand, people say it's fair market value for that price to live in West Hollywood in one of those 1960 apartment complexes. But a lot of the value add, in a way, it's like how we talked about earlier about not necessarily doing physical improvements, but you're improving the value of the leases. So they'll get the people out who have those legacy rent control prices at $1,400 a month, and they'll pay them off. Maybe they pay them 5 grand, maybe they pay them 10 grand, but they pay them off and they get a new tenant in there and at $2,000, $2,500 a month. And then they flip the property. They flip it. They sell the property with those higher rents, with the higher net operating income, and they make a killing doing this. It's just another example of a different business plan out there. This is where you pick this up from other people. This is so many things that are like they're out there. They're like, I didn't even know you could invest in that type of stuff. And that's where we transition a little bit outside of the world of real estate into like life settlements here. Did you know that I think a lot of you guys are aware that we originate people's life insurance policies and configure it in a special way that achieves like the infinite banking. And we also do a credit investor banking where you're able to flash fund your life insurance policy in 1 year and not get stuck with a really long-term commitment so that you fatten up your life insurance policy as your asset and be a better HELOC in a way and have it to be a place where you can make money tax free from and off the table of litigators. And then what people normally do is they'll fund it with, say, $100,000 and take a loan from themselves. And then the next week, put it into one of these syndicated deals to get that going. Another pro tip is if you're concerned with the whole paying interest, your loan accruing on you, then put it into like the tax file fund where you get like 24% there paid monthly, which we're actually some of you guys went into the deal before the end of the year in 2023. We're going to be sending out the first monthly payments here shortly for you guys. That's a great way to combo these two strategies, and especially a great way to kick things off for yourself. Example of that life insurance policy that we originate. Again, check out the infinite banking eCourse, separate eCourse in here if you guys are interested. And then if you're interested in setting up a call with Tyler to do some illustrations and also implementing this side strategy. But I think what people see, right, behind the scenes in this same industry, what you have is it's not like a like black market type of thing, but you have people who go through a unfortunate situation where like, maybe you get diagnosed with a terminal illness and you don't have any money to live out your remaining days and you're not going to live very long. You may live for a year or 5 years, but you have this life insurance policy that has a lot of money in it. So what some people will do is they'll sell their life insurance policy to somebody else, in this case, an investor. And this investor could be you, right? So you could buy this life insurance policy and you give this person a lump sum payment. This is where it's like some people think, oh, this is super dark. This is super messed up. But if you look at it from this point of view, like this unfortunate individual, they want 100 grand to take their family to Disneyland and move their house and fix up the house so they can sell it to the kids and do something like that. There's a need for it, and you're providing that mechanism to cash them out. As a life settlement investor, the risk is maybe this person lives longer. This is no different than I think in the 80s or 90s when people had AIDS and they didn't know how long those people would live. People would do this type of stuff and they lost a lot of money on it because obviously it was unsure. The actuaries did not know how to evaluate these types of new wrench thrown in there, which again is an example of even in something as basic as human health that's been around for a long time, you just never know what else gets thrown into the mix. And I use another example that just popped in my mind, going back to industrial properties, which over the last several years have been a great way to invest in, which is what's in our income fund right now, which is industrial leaseback properties, very state commercial backed tenants, triple nets. You think one of the most securest things we have as our offerings that we have here. Within that field, Amazon is buying up a lot of warehouse spaces all over the country. And there's other people doing the same thing that props up the whole entire asset class across the country. But nothing to say that Amazon, a very like dynamic, innovative company, can't find a way to, how about we just ship this stuff directly to our customers? And now we don't need these like football fields of warehouse space. And then they just slowly divest their holdings over 5 to 10 years, right? That's an example of a disruptor in a market, and that can happen to any asset class. And this is why I keep coming back to multifamily apartments. I just find it really hard to disrupt a certain asset class or a need like that, right? Where are people going to live, especially when you get down to 700, 800, 900 square foot apartments? Now, we're not to a stage of Asia or Europe where people are living in 400 square foot micro apartments yet. Perhaps we'll get there. At this point in time, I think we've already started to see this. The McMansions are going by the wayside. That kind of went out with the whole 1% of people in their big mansions on a pedestal and make them and rich shame them to have gone down to a little bit more average, meager living conditions. But not to say that trend will continue, but I think if you're positioned in 1,000 to 1,500 square foot living quarters or modest single family homes, I think you'll be all right. Or at least the scene is, hey, within my lifetime, I'll be all right. Or at the end of the day, you can always point at one of these asset classes or any deal and point to it as, yeah, this is a problem and this is a problem. But at the end of the day, it's like the ugly girl dance. Or if you're a gal like they're out there, you can call it the ugly guy dance. And the humorous part of it is you got to go home with somebody or you got to dance with somebody at the ugly girl, ugly guy dance because everybody's ugly. But you got to just pick the least ugly one. Like people use this saying with the United States monetary policy. And we always got these pundits that they always put out negativity out there because that's what sells attention. People don't watch the news because they're like, look at this heartwarming story. I guess unless you live in Hawaii, that's what we do out there. We're a little more positive than the continental United States. That's where people are always saying the world's going to end. Look at the debt is just going so much. And a lot of these guys have predicted the 7 out of the last 2 recessions. They just constantly predict like the end of the world and eventually they'll get it right. Like a broken clock is correct twice a day. And they don't invest at the end of the day. They're just people selling you on their affiliate link to sell you gold to scare the crap out of you. I'm on a little bit different side of this. I am also investing in the same stuff you guys are. And because I'm trying to grow my net worth. And if you're under $2 or $3 million, I think you need to be doing the same thing because that's not enough. If your net worth is $4 or $5 million and you have enough, yeah, go ahead and invest in T-bills or keep it in an online savings account. But you got to do something. And when you look at like countries, Japan's got its issues with aging population. Apparently, China has the same issues coming down the pipeline. United States has got its, I think all countries have like a debt issue, but we keep coming back to who's the least ugliest person of this ugly person party. And that's typically comes back to United States. And I'm not saying that because I think the United States is great or anything. I just think that we happen to have the world's strongest military and bully people around, and we control the world's monetary policy at this point. And that's at the end of the day, you gotta stand on some kind of solid footing. And that's where these asset classes fall, right? Like you can pick apart a deal and these asset classes all the way, but at the end of the day, you gotta deploy 50 grand a quarter or whatever you've got, your excess of 1 million, $2 million of deployable assets into stuff. Until you have, you can't really be picky or choosy. You got to dance with people what the ugly girl, ugly guy dance is what I'm saying to some extent. The other thing that some investors will invest in is note investing. The problem there with notes is it's a little bit lower return, like normally 7 to 8% for performing notes, maybe a little bit higher for non-performing notes. The problem here is like you don't get the tax benefits because you technically don't own the real estate, you just own the paper to note investing. But some people like to geek out on that, and it's something that you can do from the comfort of your own home. So the people who do that, they'll do that as an operator on their own, but then invest as a passive investor in these other types of investments where you really need to have a hands-on operator. I talked about a little bit earlier, but oil and gas is another asset class that people will do. I think it's a generally a poor investment because most times you're gonna lose your money because you're trying to drill for oil. You don't know if the oil's there. All the big players like your BP, your Exxon Mobil are taking up all the class A holes out there and these smaller oil and gas players, and there's hundreds of these little players out there. What I don't like about it is the counterparty risk. The counterparty risk is the risk that you have on your operator going rogue on you or stealing your money is unusually high in this sector. You have a lot of cowboys in here, which is why I've done one oil and gas deal personally. I just don't think it really makes sense. I mean, the only reason why you do it is for the tax benefits and just assuming you're going to lose your money on the investment. But exactly going back to the earlier question was like, hey, why don't you do some of these opportunity zone deals? I got a better way of doing it, quite frankly, that I don't have to mess around with opportunity zone deals in oil and gas. And that's the tax pile fund combined with rep status. Simple right there. But with oil and gas deals, they call them IDCs. I think it's called indiscretionary drilling costs, or I might have the I wrong in that. But the United States in the tax code at one time, they wanted to get off of foreign reliance of oil. So they said, hey, like a lot of the equipment and IDCs you guys go through, you guys can just write it off and you can write off against ordinary income without rep status. So that was a nice perk. But that was well back in 2014, 2016, and there was a sort of a phase out of it. But for me, my whole thing is, yeah, just have too much counterparty risk in this world doing it. You guys see how much Facebook ads for oil and gas investments out there. It's a clown party if you ask me. And similarly with like mineral rights are the same thing too. They're supposed to offer the same similar tax benefits as conservation easements where you're donating the rights. Conservation easements are another way that people have done this, but where you're donating the land to a nonprofit organization and the government allows you to take that right off. But the syndicator you're working with, the operator you're working with, is getting that property reappraised at a higher value. So the way it works with that is like imagine like you take a bag of clothes to the Salvation Army and say it's legitimately like $100 worth of clothes, right? At 20 cents on the dollar that you bought it at. What if you just took that receipt you got from the Salvation Army, fudged it and called it $500 worth of clothes, right? You take that deduction. As you can see, that's where it's a little bit of a gray area. And that's where we generally don't recommend it these days. And when I say we recommend, again, I'm not a tax attorney or a CPA. For that, again, reach out for a referral. That way we aren't people you're upset at when it doesn't work out. As again, we're just providing infotainment And hopefully you guys enjoy these types of sections. But yeah, I've invested in coffee farms and chocolate farms. I got a couple parcels of those. But these are just different types of investments. There's mobile home parks. I've done that. I'm not a huge fan of mobile home parks unless in certain situations. You got to really dive into that asset class a little bit more. In It seems like a simple, like, real estate play, but really it's like a predominantly a play of you gotta sell the houses. So it's almost like you have a little bit of real estate, people buy or renting out spaces, but it's like you have a car dealership on your lot, and profits are resting on selling the mobile homes to people as you become a dealer for those homes for people. But all kinds of things you people invest in, investing in fine wine, art, collectibles. You're seeing a lot of, like, with the rise of the crypto and online platforms, you have these firms securitizing assets and then selling off the securitized portions as little as $100 each. Every time I look at those types of things, the friction costs for them, the expenses for them to put something like that together, and then the asset management, the fee structure is very lucrative for those people where, but yeah, maybe if you are the one holding on to the wine in your own house, but then again, you better insure that stuff, right? This one of my criteria. If I were ever to do one of my lessons learned, if I were able to do like a agricultural play, is I want that to be number one in America, and number two, I need to have those crops insured. At some time during the pandemic, people they watched that Michael Jordan documentary, and trading cards, sports cards got really popular there, and you could make a lot of money doing that stuff. But again, that overlaying my value system or some things I really am really sticklers on, I'm like, you better insure that Michael Jordan card. If you can't pay for the insurance and still make a good return, then I'm out, right? Because it's a very fragmented market. You got a bunch of idiots buying Michael Jordan cards, but it is where person just coming back to the basics and things that we control as operators, apartments, development, multifamily, workforce housing developments. But definitely, I think you're going to see us do some other things in the future. Get maybe do some venture capital stuff, some maybe tech startups. I would probably, if I were to do a tech startup, I want to do things that I'm versed in. I run a business, so different B2B tools and services. Also, I overlap in the fintech world, in the real estate world. So I know those industries, and ideally, maybe if I could do value add, help out with the investment, that would make a lot of sense. Nowadays, you're seeing a lot of people with the dying workforce of baby boomers leaving the workforce. You're seeing, I think the staggering statistic was only one third of mom and pop businesses out there have a succession plan. So you have a huge amount of these baby boomers retiring, and their kids don't want to take it over. And because just think about it, a lot of you guys are in this situation, right? Like you're the first generation multimillionaire, but your kid, you probably sent your kids to a good college, and they're going to become a professional in something completely different that you did, especially if you were did a family business. Yeah, the kids typically don't take it over and go off to a more defined profession like a dentist, a doctor, a lawyer. Maybe if they're dumb enough, they'll do an engineer because engineers don't get paid too much and it's a life of technical misery. It's typically normally what happens. Essentially, if there's sophisticated business owners out there or a capital group like ours to find a good operator to pair up with operator to go buy those distress sellers like that, we can make a good price. And you combine that with the fact of getting seller financing from the seller, just makes it so powerful and lucrative, especially when you even it just in a way, what we do is we bring in capital, and if you've heard the term, money magnifies things and augments things. Just like how it makes better people, and bad people worse people. If you're stingy and you're minded, and you're always thinking like, how is I want to save money the most, and you get more money, you're going to be more like that, more than likely. If you're generous, a kind person, you get more money as a magnifier like that. You're going to be better. Same thing like business owners. Good business owners, when you turbocharge their business, And this is what private equity does. Unfortunately, retail investors are not able to get access to these private equity deals unless you write a 1 million, $5 million check. But this is where our group is disruptor in the industry in the way we pull in hundreds of investors together. We have well over 900 investors now who've invested in our deals. It's like a lot of these other so-called competitors of ours are always like, we have this many investors. And I'm like, yeah, dude, that's just how many you have on your list. Only a fraction of those guys are actually investing in you. But that's where we're able to, with the collective power of this Hui, right, our investment group, get access to better deals. And I guess that's take the lessons learned that I've had investing with bad partners in the past, bad deals, and also good partners, and pick the horses or pick the jockeys, however you will, and also assist with the operations and guide our group, myself included, investing alongside of it, finding the right business operators to maybe go take over. We've got a lot of dentists in our group, in our mastermind group. How much I would love to work with one of those people. We've built relationships over the several years now. And if they want to open up their second or third dentist franchise, not only is that in the medical office asset class, which is great because of the increase for medical needs in the future with the aging population. And I just think that's a cool thing when, people can pair up like that and can be pulled in from 100 plus investors and go and invest in power a good operator, an honest operator, and augment what they do in Vistage and EO. And one thing I always see of like business owners, it's not the business, but a lot of these guys like to build teams and community within their own business. And it's not about the business, it's not about the operation, but it's more about the onboarding of people and the right people and coaching and counseling and developing their team. That's really what I think a lot of investors don't really see on that back end of, and money is the magnifier on that. Now a good dentist can replicate what they did 2, 3 times, 4 times, 5 times, and now have 50 people that they've now employ in good jobs and good teams where they can have great livings in good working conditions and make a difference. But yeah, be on the lookout for stuff like that, non-real estate type of investments. Things that come to mind, like professional services, like CPA firms is a big one, especially if you're able to come in with a sort of manpower disruptor, which is essentially the secret sauce, which isn't going to be around for the next 5 to 10 years, as any opportunity is somewhat fleeting. But this is why investing in businesses are a little bit more asymmetric than real estate. You're gonna more than 2x, 3x your money, maybe a lot more than that. But some people say it's a little bit more risky, but in some situation where you have an unfair advantage and you're buying the pre-existing business from, say, just an aging CPA who has 300 clients and they're making $1 million off of that in revenue, and you're able to beat them down off of and buy it for $500,000, 50% of revenue. That's an amazing find. And that situation is created by a distress seller situation. And you might be able to grow that to a 3, 4 times of that, even on the EBITDA side. But hopefully today's talk, I didn't want to, I think I'll leave people with this. A lot of people, we talked a lot about a lot of different asset classes here. The mistake is, in a way, we unleashed you guys in one of those really good Las Vegas buffets where you got the Chinese food, you got the Indian food, you got the spaghetti, you got the pizza, you got the dessert, you got the French food if you're one of those fancier places. A common mistake that I think new investors make is they're like, oh, let me go grab some of everything. And this is a term that's called worseification. Worseification is when investors get diversification in different asset classes, but they're just getting like the junk stuff, right? Like you're running around, you're grabbing the pizza or the rice or the noodle. And of course, nobody does that. You got to be stupid to do that in an expensive Las Vegas buffet. But people do that in terms of investing and give me the self storage. And they go and they ask around who's the good self storage operator. I see you guys doing this. You guys invest with the same group of people that are really good at marketers that I haven't seen them do go full cycle on any deal. If you want to know who that is, join the family office group and figure that out. But you guys, very common to do worseification. What I would recommend as opposed to that is figure out
one asset class first that resonates with you and you understand. You're not going to fully understand it, but you understand you can dig in deeper. For most people who've lived in apartments or own rental properties, that's apartments. And that's my track record or my path into this. You get first in one and you build a decent portfolio, 5 to 10 deals. Invest $250,000 or $500,000 in that one asset class before you even branch out. From there, I think the path is counterintuitive, but this is where you meet other passive investors who are already investing in the same projects, multifamily deals that you are. So there's some commonality. And then from there, say, what self storage group have you worked with in the past, or industrial operator you worked in the past, or multifamily development operator, developer you've worked in the past, and then go off in that way than to just go off of whose podcast you're listening to or who's on the Facebook ad that you just saw the other day. Because oftentimes those guys aren't really the best operators, in my opinion. That's what I try to do. I try and find the absolute worst marketers out there. The best operators out there are the guys who doesn't want to deal with passive investors. They're annoyed by passive investors because they're more like, I mean, if you call it left brain, right brain sided, they're more on doing the damn operation. And that's what you want. So what we try to do is we try and find operators, especially when it's outside of multifamily apartments, that cater towards more sophisticated investors who are bringing in $1 to $2 million checks at least. And this is where we, as a group, can write that $1, $2 million checks to get into those even those next echelon of operators. And this is where it's like, this is what's tough when you're starting out. When you're just a guy writing $100,000 check, you're stuck with a bunch of jabronis who just went to a week at boot camp, who's under $1 billion assets under ownerships. They're just playing the fake it till you make it game. And trust me, been there, done that. I went to a lot of those types of conferences, paid tens of thousands of dollars, over $100,000. I've wasted my money. And all they do is teach you how to look good on social media and all that type of garbage. Where my maturation process through these last few years is we know how to underwrite the deals and we get invited to higher level investment groups and we just like how you guys are doing, but on a different level, network with other operators and figure out who are the good people out there. And then we match make and find situations where we can come in as a group and we take a part of there. And that way they don't have to worry about 50, 100 investors, right? They can focus on what they do. But yeah, it's a little bit more into the inside. I think a little bit behind the curtain on how these different rungs of echelons of operators are out there. And sometimes it's good to be the smaller person within a deal with a lot bigger players in there because especially if when tough times happen and they do, and there might be a need for a $5, $10 million capital call, you want to be in those types of deals with family offices where two guys are just like, hey, how about we split it? You do 3 million, I'll do 3 million. Yeah, let's just get the deal where it needs to go. And that's where it's tough being in deals with retail investors, doctors, dentists, guys who aren't really sophisticated investors in there. But yeah, I think that's the way we're heading as an investor group in the future, especially as we head into different asset classes as we've discussed here. So if you guys are new to the group, make sure you guys check out the rest of the syndication e-course. We've been getting the portal where it needs to be. Sometimes investors get confused with the portal. So if you guys have any questions, reach out to the team at thewealthelevator.com. And then if you guys are new to the group, we do allow you guys to test drive one event. You guys have to pay, of course. Nothing's free here. But that way you can meet the community and meet myself, see if it's a good cultural fit. We don't want people who are just looking for where do I invest, that type of stuff. We want people who are lifelong members and bring the next generation, their kids into this type of stuff too. If you guys are listening to this and not getting access to stuff, go to thewealthelevator.com/club and we'll see you guys next time.